3, 2, 1. What's up, Jerry?
Here we are. Excellent.
Are you checking your phone right before
making sure
the
market doesn't change or the phone's turned off.
Yeah, the phones are turned off. We know what you got. You guys probably wouldn't hear it. I don't know. Usually these things do a pretty good job.
These headphones are good.
Getting rid of everything else. I think somebody did make a comment or sent me a message or something a few weeks back about, why don't you guys use like the microphones or whatever? And I was like, this makes it so much easier. Like, it's like college game day headphones, right? And we don't have to worry about moving the microphone around. So
we have that. I mean, I use the microphone at the house, and but it's
we got the Joe Rogan setup. Actually, on the other side of this, my microphone's over there by the desk. Yeah. One day we'll have to do a little behind the scenes video of what the rest of this little studio looks like. Not
a big studio.
No.
Little studio. Yeah.
What do we got this week? Let's talk about it.
So, in full transparency, because that's what we do, transparency.
We try to be, yes.
Yeah, more or less. Much more than less.
Yeah.
We are headed out of town this weekend, so we're recording early.
Yeah.
So it's going to be a little bit different than usual. I only have one chart, which I'm calling the only chart that matters right now. and it is the only, really, in the big scheme of things, the only chart that matters as far as TSP investing. But we're going to kind of, I don't want to say tackle. People might get offended of tackle. So we'll just ease into this idea of managing risk, right? I think I got some things to kind of hopefully make people that are firmly in the buy and hold camp some things to think about.
Question their life choices.
Yeah.
So I do want to point out, though, when you're watching this on Sunday evening, even though we did this early, if you're not a member, you get this free anyway.
Right.
Right? Don't complain to us if we did it early. It's very rare that we do this. But I'm saying that to point out, if you are a member and watching this, we definitely don't do the newsletter and all the analysis until, like, even though we're out of town this weekend.
Oh, I'm doing all the analysis.
We'll do all that on Saturday and Sunday. I mean, we work more on Saturday and Sunday than most people do.
It's the work week.
Yeah, because the market closes at 4:30 on Friday, and that's when it starts for us. So even though we just won't have the equipment to be able to do the show, but Jerry's still going to do the newsletter, the video, and all that stuff. That always happens on Sunday. So don't ever worry about, I didn't get all the info. Yeah. If you're a paid subscriber, you definitely are getting all of it.
Yep, definitely.
All of it and more. All right, man, let's get into it.
Let's kind of get into it. All right, so what we're going to do, we have a lot of new subscribers. We're pushing like 17,000, right? In the public Facebook group. So this is basically, since it's on the, gets pushed out on the public Facebook group, this is basically for you guys. So we're going to kind of talk through what the two Facebook groups are and what you get if you're actually a subscriber to the site. And then, like I said, the only chart that actually matters right now, it's a weekly chart, so the fact that we're doing it a couple days before the weekend isn't a big deal. Then we're going to kind of challenge the conventional wisdom, which I would argue that the conventional wisdom is buy and hold. And
you know me, I like to challenge everything.
Yeah, well, I kind of do too. We just do it in a little bit of a different way.
Yeah, we're a little rougher about it.
Yeah.
So Jerry's the nice cop. I'm the bad cop. It's always been that way.
So we're going to poke at that a little bit, and I got two recent Facebook posts that they're both very similar, and there's a lot of things we can talk about them. And they both had like over 50 comments in each of them. So cool. I just wanted to address some of those things. All right. So public Facebook group, right? The point of we have two groups, right? The public Facebook group and the members only Facebook group. And the point of both of them really is education. But in terms of the public Facebook group, the point is to educate and inform government employees and military service personnel using the TSP weekly update show, which is this, periodic Facebook Lives that we do, pushing out relative content from other financial media sources that I do quite a bit, and providing a platform for TSP-related discussion. Okay, that's what the public Facebook group is designed to do, right? So anyone new to Grow My TSP should absolutely download and read the ebook. Yeah,
if you haven't done that, it's all over our website. There's the button on every page. You can also just go to growmytsp.com/ebook and find it right there. I always tell people that, like, I kind of run into and they ask me about this. I'm like, just start there.
Yep.
Because if you never watch anything we do, if you never pay attention to us ever again, but you actually read that ebook, you will be, I don't even know how to explain it, exponentially farther along in your education of managing your TSP than we ever were in 20 years, or when we started out.
And it's not just about charting. I mean, the ebook covers all kinds of stuff that's TSP related and how to think about stuff. And we talk about our methodology for maximizing gains and minimizing downside risk. But there's a lot more in there than just kind of our charting methodology.
Yeah. I mean, basically, it helps you figure out how to approach your retirement account, because that's what we're focused on, retirement accounts, 401k, IRA, 403b, whatever your flavor is. Those should be treated differently than your other investment
brokerage account,
anything investment wise, right?
Yeah, true.
And so that's what we focus on. We're actually writing a larger book on just how to invest in your retirement in general. That's going to take a lot more work, but it's you approach it differently.
Yep.
And so start with the ebook.
Yep. Start with the ebook. And so after you get the ebook, you get a series of posts with video attachments that explain everything from our investment philosophy to how to read a price chart, right? To decide when to reallocate between the funds to maximize gains and protect against downside risk. So if you're new to the group or you haven't read the ebook yet, definitely this is the place to start. All right. So that's the public side, right? The members only group, Facebook group. If you're a member or a subscriber of the site, we have a separate members only Facebook group for you guys. This group is for people that are kind of more serious about taking all the gains the market gives us and protecting against catastrophic losses, right? So this group focuses more on in-depth technical analysis of the TSP fund charts. They get weekly TSP newsletter, alerts and analysis to validate their reallocation decisions, periodic market updates, and the monthly members-only webinar. You also have access to all this on the mobile app, and we push notify through the mobile app our reallocation alerts.
Yeah, and we also do when we have market updates. The app comes in handy if you're a member. If you download the app and you're not a member, it's an easy way to get to the show. It's an easy way to get to older newsletters, maybe. But you're not going to have the same amount of satisfaction with the app unless you're a member. And
right.
it was meant for members. Right. The reason I like it, I spend more time on it when I'm trying to go to a video or go to the newsletter, because it's easy on my phone, and it stays logged in.
Yep.
Yeah, but I don't want to skip over the monthly member webinar.
Yep.
Because there's a lot of value in, again, if that was the only piece you got, was once a month we sit down on a webinar, and we use a webinar format so that it's live. All the members are there. They can talk and ask. It's just like a Zoom call, right? Yep. But we use a webinar format so that we can get as many people on there as we want. And so we're able to take questions from people. We review all the moves that we've made for that month, and we go back and remember why we did them. And it allows people to, that's where the real deep education comes in. And the
Yep.
people that come to those webinars each month, I see them, having more thoughtful discussions as we go along, right? So they're getting educated. So I would definitely advocate, if you're a member and you're not attending those webinars, and a lot of people watch them afterwards.
We'll watch the recording,
yeah,
sure.
And that's no problem. I tend to do that with webinars too.
Yeah.
We record it, and so you don't have to be on it live, but you get a lot more value out of it if you're on live.
Yeah.
But anyway, just wanted to touch on that a little bit.
$25 a month, $250 a year.
This sounds like webinar.
Yeah, I mean, but again, no one else is putting out content that's solely focused on TSP.
Yeah, I mean, the only other place you can normally read anything about the TSP is Federal News Network.
Yeah,
like that's it, and it's the corporate. Right. It's never going to be controversial at all, right? It's just as bland as it can be. It's once a week, but I don't. We looked for all this analysis, and that's why we.
It's not there.
Yeah.
Okay, so just to be clear, because we're talking about basically the public side of the public Facebook group, right? So just to be clear, that's what we do at Grow My TSP, right? We have a free educational side and a paid analysis and alert side. Our methodology is active management of the TSP funds with the objective of being on the right side of the market. We want to be in the stock funds when the market is trending up and protect against downside losses when the market is trending down. So we have lots of questions. It comes up all the time. the Grow My TSP, I don't know, it doesn't say that the group is about technical analysis and
it actually does say that in the group information. Yeah.
I mean,
I put it in the rules. Like that's what our focus is.
It is our focus without a doubt. And we're also open to other ideas about how to do it, right? If you're a seasonal guy or
we talk about seasonality,
fundamental analysis, whatever, it's fine. But the point of it is or I shouldn't say the point of it. The point of it is to grow your TSP, right? And talk about whatever you want. And we're not trying to disparage anybody's strategy or methodology or whatever to do it. We just have one that we think works for us, and was the foundation of why we built the group. So,
and I think the difference though is not that we are open to all strategies. Where I have a problem usually is when someone doesn't have a strategy at all, but they have such a strong opinion.
Yeah,
right.
There's a lot of that,
and that's the internet. Like, don't think that we've forgotten that this is the internet. That we know that they're just going to be crazy people on the internet and people that want to kind of stoke the fire. Yeah. And I've gotten in trouble a couple of times for stoking the fire.
No,
but mostly it's just because if you want to have a meaningful discussion about a strategy, I want to have that discussion.
100%.
Yeah, but if you want to just tell me that, well, this works and it's just because, and there's no,
it's the way we've always done it, or whatever.
You don't really have a strategy. I don't want to have that conversation. It's a waste of time, right? And that kind of ticks people off sometimes, but I just don't, because I always tell people, if you spent 30 seconds thinking about it, I don't want to talk to you about it. Like if you spent hours thinking about it, we could have a good discussion. Yeah. And we've spent years thinking about it. Yeah. You've spent decades.
Yeah, quite a while.
And the funny thing is a lot of times we kind of get, saddled with this timing the market or just technical analysis. And I mean, I'm probably more of a fundamental guy than Jerry is, but I respect technical indicators because they work. Right. Like it's hard. It's hard to say they don't. Like you'd have to, again, I'll be happy to have that discussion. Right. But you'd be hard pressed because we're not the only ones that believe in them. Right. There's a whole industry back behind technical indicators. But yeah, I mean, really what we want in the group is for people to have meaningful discussions about this topic. Right. And we don't have to agree with it.
No, I would love to have somebody say, hey, the FANG earnings are through the roof and the market is still consolidating and coming down. Do you think that's an indication that the market's going to pop next quarter? Like, something like that.
That's a cool discussion.
Yeah.
Yeah. And we do have some of that.
Do you have some of that?
Yeah, we do. And then we love it when we see that. There was a post like today or yesterday that I thought was, well articulated. They had looked at a particular chart. I'm like, man, that's what we want.
Yep.
Like,
100%.
absolutely. Because you're not going to find that, at least we're not going to find that anywhere else. We haven't found it somewhere else where people have those meaningful discussions. The other groups that we were a part of before we created this one was basically just like buy CNS and ride.
Yeah.
Like there's nothing discussed then. Let's just go home and leave it.
Right.
Yeah.
Yeah. 100%.
All right, let's keep going.
Okay, so we said the only chart that matters. So this is the, ordinarily I go through all the TSP fund charts for the week, but at the end of the day, if you've been watching this at all, or if you haven't, this is the only chart you need to really look at. This is the 2-year weekly chart of the C fund, right? The S&P 500. Here's the the low down here from COVID. Each vertical tick is a week of price. Okay. So here we are somewhere in the middle of the week that you're going to be watching the show. It doesn't really matter where we do the show this week because the only thing that matters in this chart is when price gets back above this downtrending trend line, downsloping trend line, and or when price gets back above this 20-week moving average line, the blue line. Until the price of the C fund gets above the trend line and or I'll say above that 20-week exponential moving average line, there's no reason to be in the stock funds. You got the relative strength indicator below the 50 line. Okay? It hasn't been below the 50 line since before COVID. Something is definitely different now. Okay? we can talk about all the different head and shoulders patterns and, a flat pattern. I mean, I have all kinds of opinions and possibilities about where the market's going to go. But at the end of the day, it either keeps going down or it gets back above this trend line and this moving average line, and that's our chance to get back in. So that's really the only chart you need to look at. Okay. So, like we said, we're going to challenge the conventional wisdom a little bit. So, keeping in mind that the active management methodology that we just stated, right, we just talked about, we need to kind of talk about why we're challenging this conventional wisdom of buy and hold. So I got a quote here from Warren Buffett, right? Everybody loves to quote Warren Buffett. He is the patron saint of buy and hold crowd, without a doubt. But when you look under the hood, Warren Buffett basically utilizes the same risk management philosophy that we use. Minimize downside risk and avoid catastrophic losses, right? We talk about that all the time. So here's a quote from Warren Buffett. The biggest thing is to have something in the way you're programmed so that you don't ever do anything where you can lose a lot. Okay? So you're programmed. You're in your mind, you don't want to lose money. You don't want to put yourself in a position where you can lose a lot, right? A lot doesn't mean none. Because if there's risk, you're gonna take some losses. But you don't want to put yourself in a position where you're gonna lose a lot. Okay? Our best ideas have not been better than any other people's best ideas. But we've never had a lot of things that pulled us way back. We never went 2 steps forward and 1 step back. We probably went 2 steps forward and a fraction of a step back. Avoiding catastrophes is a very important thing. Okay? It's risk management. It's the way you come to the market that if not taking losses needs to be your primary objective, because you're going to let your winners run. Not taking losses has to be the primary objective. So if we look at this in terms of a career, right? This is a long-term monthly chart of the C Fund, goes back to 1999, and it really illustrates the value of understanding basic technical analysis to manage downside risk, right? So this is goes back to 1999. Each tick, each vertical line is a month of price movement, okay? It's a logarithmic scale. So it's a percentage-based scale. Instead of doing the price evenly distributed across the y-axis there, it's a percentage basis. So what that means is this green line right here, okay, the length of this green line, I took it from 750 to 1500, right? So it's this length right here, okay? It's the same, the length is the same if you go from 750 to 1500, or if you went from 1000 to 2000. The length of the line is the same. Or if you went from 2,000 to 4,000, the length of the line is the same. So it gives us a way to compare. It puts things in perspective. Okay. So from the top in 2000 to the bottom in 2002, okay, that was the length of the green line. It represents a 50% loss, or it represents a 100% gain, right? Because from 750 to 1500 is a 100% gain, where 1500 down to 750 is a 50% loss. Okay? So all we did in this example is connect the lows from the previous bull market and observed where the trend line broke. Okay, so the trend line broke like right there. Something happened there, because this up move, if you remember, from 99, I think 90, we had a recession in 94. It broke out in 95, right? And then we had in 97, we had a little blip there. But for the most part, we had this bull market that went right up from 95 to 2000. So if you had $1 million in your TSP at the top in 2000, and if we forget for a minute about how you kept making contributions and buying shares cheaper as price kept going down, which is true, which you did. But if you set that aside for a minute and just say, okay, I had $1 million right here. By the time the market came down here, my $1 million, if I looked at my account, it was $500,000. It took until 2007 to get back to your $1 million, only to roll over again to the bottom in 2009. This was a 55% drop, right? You can see how it's lower than this 50% drop. This was actually a 55% drop.
So if you just rode the market, let's just make it clear. You had $1 million. You went down to 500,000.
Yep.
It took that long to get back to $1 million.
Yep.
Not counting your contributions along the way.
Right.
There's no way we can factor that in.
Right.
But our point is your largest portion of money over time is your account, not your contributions. Most of us aren't making. You can't make tens of thousands of dollars in contributions, right? There's a limit.
Making $19,500 a year. That's
exactly.
It.
So the point here is that your largest bucket is your account.
Right.
So I just want to point that out for context as we keep going through this, because I love this chart. You know I do.
Yeah. No, it's a great chart. So you had a 55% loss down here. So now you're, I don't know, 450,000, let's say, from your $1 million. It took until 2013 to get back to where you were in 2000, right? You got back there in 2007 only to roll over again. So in 2013, you finally got back and started making some gains going forward. So that's 13 years, right? If you're a 6C guy like we were, it's half your career. So half your career, the market was flat.
Right. And people wouldn't. We're going to have people say that that's not true, right?
Well, it
is true. It's facts.
It's absolutely true.
Hashtag facts.
Yeah.
Yeah. It was basically flat if you wrote it out. And, I was one of those people. Well, I'm going to tell the story all the time. Like when I knew Jerry, but I wasn't following Jerry until that 2008 time frame.
Yep.
And I was sitting in my cubicle at the time as a little govy worker.
Yep. And
I was following your newsletter, and I was out. I was in the G Fund. I didn't know why. I didn't care why. I was in the G Fund. And all these other people were just dying and crying, and I was like, holy cow, this sucks. And that's when it really shook me to like, hey, because I was in the Army on the previous one, but we didn't put as much focus on the TSP. But then this was where I was building my retirement account, and I was like, man, I got to pay attention to this. Yeah. And that's when I really started educating myself, was in 2008. And then here we are. And so that's what we're hoping you guys are starting to, get a sense of, because I know where Jerry's headed on this chart. So let's keep going.
Yeah. No, I mean, there were some comments. We're not gonna talk about the specific comments, or at least the comments to the posts. I'm gonna show two posts from Facebook in the last week or two that generated a lot of comments. And one of the comments specifically was, I've been in the government since 1996, and I've never seen it take like more than a year. I've never seen it take basically a long time to recover. And I saw that comment, and I'm like, you came in the government in 96. What do you mean?
How could you not?
Right. Either you weren't paying attention, or you weren't paying attention. How could you not see?
Or maybe they just don't know better, right? And that's what we find a lot, and that's why we're so obsessed with educating people, because if you have a different opinion, we're fine with that. Just have an educated opinion. If you tell me in our discussion that the market has never taken a loss longer than a year, we're done. I can't have that discussion because it's just not factual, right? I mean, the reality is it does go down, and what we hope is that we can catch that larger trend change and be out, right? That's our methodology, right? And it goes back to Warren Buffett's quote, because you do want to miss those catastrophic losses.
I mean, is 50% a catastrophic loss?
To me, it is.
Yes, you're 50 years old, right?
Yeah.
To you, it's a huge loss. To me, it is too.
Yeah.
If you're 25, it's a catastrophic.
Still a huge loss.
So I had this conversation with my son the other night, right? And I showed him this chart because I was building the webinar, and he's 23, and he's very on the ball. He has an IRA. He contributes to the S&P 500. and he doesn't pay attention. He contributes to the S&P, and we don't talk about it a whole lot, but the other night we sat down and we talked about it a little bit. And I showed him this chart, and it took me 10 minutes to show him that you could make a small handful of changes over the course of your career, and it would absolutely change what you have in
exponentially
the end.
Change your account balance.
Yeah,
yeah,
100%.
Yeah.
It was simple because I had the chart ready. I showed him the this chart, and then I showed him the one that we just talked about, the only chart that matters.
Yeah.
And I'm like, hey, Jordan, at the end of the day, all you got to do is look at this chart, and when it's above the 20-day exponential moving average line,
yeah,
keep being in the SPY, the SPY.
Yeah.
When it's below that line,
get out.
Don't be in it.
Yeah.
I mean,
it can be that simple.
Yeah. So, okay. So if you're a TSP investor and you're looking at this on a long term, again, each tick is a month, right? Each vertical line is a month. If you wait for the monthly close and you got out here because that was the trend change, right? You didn't get out at the top. I mean, say you took a 10% loss from the top. You saved yourself the rest of this. I mean, it wouldn't be 40%. It would actually be more than where you got out here, but you're saving yourself a huge move down, right? And then you just connect the tops. You connect the tops. When it breaks out through the top of that long-term trend line, you get back in. You missed from 750, let's call it up here to 1,000. That's a huge move. That's not timing the market. You missed a huge move off the bottom. But then you're going to get this whole move higher, right? And if you get in here, it's your least risky, because if it rolls back down and gets below the trend line, you just get out. So in this case, it does, and it keeps going. Okay, you connect these trend lines. Let's say you get out here when it comes down, right? Because now you had $1 million up here. You got out here. I don't have the numbers with me. We did this a while ago, but you get out here. Say you had, I don't know, you lost 10%, so you had 900,000. You have 900,000 in here, and the market goes up 100%. Now you're at, whatever it was, you're double what you had. Your 900,000 is 1.8 up here, right? If you get out down here, maybe you got out when your 1.8 was 1.6, or say you were back down to $1 million. Who cares? There was another 50% move down. 55, yeah. You get in here, you're not getting in at the bottom, and you're taking a huge. You're not gaining this. You're not getting this because you're waiting for the market to validate that it's going in a new direction. And then you take your $1 million that you had left here, and by the time you get back up here to 2013, you've made another, say, even if it was only 50%. Now your million's $1.5 million, and you're still $500,000 above where you would have been if you wrote it out.
Yeah, because everybody else that just rode that hole up and down is right back at $1 million there. Yep. 13 years later. I really hope that sinks in. I mean, I hope that people don't see this as some sort of kind of like smoke and mirrors. Like it couldn't be more factual. And and we have people that are just so obsessed with this idea that the market always goes up. And that's a generally true statement.
Yes.
It is. But it does when it does go down catastrophically, you do not want to be in the market. And all of us are in careers of 20 to 30 plus years.
Yep.
If you're lucky, you do 20. If you're law enforcement or air traffic controller or whatever, there's certain careers that you can do quicker. But most people are 30 plus years.
Yep.
And that has happened how many times in the last 30 years?
Yeah.
Right? I mean, you don't want to take that. That's our point, right? You just don't want to.
So if it takes 13 years, now, I mean, given this, those two big downturns in a relatively short period of time won't happen very often.
But when they do,
you don't want to be in it. It just
and if you listen to analysis from all over the financial industry right now, most people are consistently saying that we could be looking at another one.
Sure, we could.
Right? We don't know. We're not going to pontificate, but all the data is pointing to the possibility, okay, and the probability. That's even more important. the probability is increasing that we're getting close to another one of those huge drops.
Yeah.
And we're not going to be in the market when that happens.
No. I mean, we're not in the market now.
Yeah.
So, but actually, that's a good point because that brings me to the next piece of this. So we get back in the market here when we get a break above that downsloping trend line, right? We get back in the market, we draw the trend lines. We had an overshoot from COVID. Okay, that's a whipsaw. We would have gotten out and had to get back in because it broke the long-term trend line and then turned right back up. So here we are today, right? We are almost at the top. I mean, I know in the very short term, people are freaking out because the C fund's down 10%, S fund's down 15%. And so people are starting to acknowledge that there's a problem. But from my perspective, the problem is visual on the chart. You can see it. We've been going up in this straight line. And now we have a change in the pattern, right? And it's not only that we have a change in the pattern, it's that the indicators are telling us. So the relative strength indicator
it's rolling over.
Is rolling over. And what happens when it rolls over? This long-term trend, okay, it's intact even if price comes all the way down here to this trend line and still goes higher.
Yeah, big picture, that if you looked at that over the course, it's not a big deal.
Yep.
Except the fact that how much of a percentage loss is
it's
that?
Like 30% from now.
Right.
I mean, I'm not taking a 30% hit in my retirement account right now.
Yeah, and that trend line that Jerry's showing you there, that's your risk factor. When we talk about managing downside risk, that's what we're talking about. Is you don't have to have all the technical analysis knowledge and experience that Jerry has to look at that chart. Even a dumb infantryman like me, right? I can look at that chart and go, there's a long way from the top to that trend line, right?
Yep.
If you look down farther in that chart, there's not as far, right? So there's not as huge. There's not this huge risk. And the reason there's a huge risk is if you guys look at that chart, look at the angle that line is going, not the trend line, the other one. Can you draw on that, Jerry?
Post-COVID. Like
post-COVID. Look how hard and high that's going. That's not normal, and it's not sustainable, and that's not Conan saying that, right? If you go watch any financial news or anything, right, and they're all going to say the same thing. That is so steep that it's just not practical that we can hold that. That doesn't mean we're going to have this crash.
Right.
It just means that it could wiggle down and kind of level back out to what we would call a normal angle that's more sustainable. But what are we talking? Is that a 20% loss? Is it a 30% loss? You know what? Like we don't want that.
It doesn't have to be necessarily a loss. As the trend line slopes up, price can come down and they can meet.
Yeah.
That's called a correction.
Right.
Right. The other way is the price comes crashing down to that line, and that's called a crash.
Right. Yeah. And there's some debate as to whether we're in a correction or we're looking at a crash. Either way, there's no reason to be in the market.
No, there's no reason looking at this chart to be in the market.
Now, the question everybody will have for us if they're paying attention to this, they're watching it, or really thinking about it, is okay. So now is not the time. So when do I get back in? Right.
Sure.
That's what they're going to ask.
Sure.
And it's actually a pretty easy answer from my standpoint. Right. It's when the trend changes. Right. Yeah. So when you're not going to catch it right as it happens. We're not going to catch it because we're going to wait for it to confirm. Right. That it is now on a trend to back up, and then we're back in the game. Right. But until that happens, the risk, look at the distance.
Yeah.
The distance between that line and that line is just too far.
I mean, the distance, this is a 35% drop from COVID.
Yeah, that was 35%.
It's pretty much 35% from where we are now down to the trend line. And then, we're kind of assuming that we're going to get support at this trend line.
Yeah.
Right. At some point, we're going to break through that trend line.
Now, if you want to play this, if you want to take what we're talking about and play this like to the really get in the weeds, right? You could take your larger bucket and stay out of the market.
Yep.
And you could take your contributions and wait for you can play that game. Our point is most of the time the amount that's largest and that you want to protect is in your account. Yeah. And so a lot of people really lose track of that, and they say, if you get out, you lock in your losses.
Yeah.
Your account's going to go down whether you lock it in or not.
Right.
That's the part that it, and that's the difference between a retirement account and a brokerage account. When we talk about locking it in, yes, you lock in your losses, but most of the time in the brokerage account world, what they're really concerned with is the tax implications of doing that. Meaning, not only did I take a loss, but I'm going to have a tax implications. Right. We're not talking about that in retirement accounts. So there's no tax. I'm not getting penalized for getting out and saving what account money I have.
Right. We should kind of talk about that for a second, because the idea of I'm locking in my losses, it's relative, right? If you say, if I move to the G fund now, I'm locking in my losses relative to the top in January. That's true. But if you had been in the stock funds through 2021, your losses relative to when you got in 2021 are very low. And you can see that there's been a clear change in the trend of the chart. So kind of back to the Warren Buffett, quote, he didn't acknowledge that he's not going to take any losses. He's saying he wants his losses to be very small, right? He's taken 2 steps forward and a fractional of a step back. That's where we are right now. We've on this chart, we are a fraction of a step back versus the gains that we made, from the COVID move higher. So, if you are stuck on this idea of, if I move to the G fund, I've locked in my losses, I would just suggest there's a different way to look at it, right? Yeah. I don't know. There's so much stuff I could just say about it, but I don't,
That's about as much as we can explain.
Yeah. I mean, let it sink in and percolate. If you don't agree, then great. Yeah. Keep on doing what you're doing. But
and we'd love to have comments on this one that have, thoughtful responses, right? And you don't have to agree with us, but if you have a different way of looking at this that is more practical, please share it with us, because we're constantly trying to tweak this methodology. It's just that, over time, there are some fundamentals for us that don't change. The fundamentals are, first rule, we don't want to lose money. Catastrophically. Right? When we say that, you got to caveat that with, I'm okay with losing 2, 3, 4, 5% if it keeps me from losing 50. Right. If you
never know, right? No, you never know how low the market's going to go.
But we'll get back in.
Yeah. Right. You can get back in. So the other piece of that is, and we can't even honestly, we'll have to do this discussion on a different show. We did a little while ago, but the difference between thinking about TSP investing in terms of shares that you own versus the dollar value of your account, right? Your value of your account is what it is. You can own shares in whatever the TSP funds, but your dollar value of your account goes up and down.
Right.
When you say you locked in losses, if you are if you have $1 million and it goes down 10%, now you have 900,000, and you move it to the G fund, you can say that I've lost 10% of what I had, or you can say I'm managing my downside risk, right? Because if the market continues down and you bother to go backwards and look at the numbers and say, well, this is good. Yes, I locked in a 10% loss, but now the market's down and I would have had a 25% loss.
Right.
So maybe you just say, okay, that's good enough. Now I'll get back in, and maybe it goes lower, so what? But I know at least when it comes back up, I'm that much further ahead in the game.
Because you managed your downside risk.
Because you managed downside risk. Yeah. Think about it. It's much more valuable to think about it in terms of the dollar value of your account than how many shares you have or whatever. Okay. All right. So we're going to kind of go into the same things, but there are two posts on Facebook that I just kind of want to talk through. So the first one, I just left L2050 and went to 80% C fund, 20% S fund, right? I have 25 years to go. Should I care about today's market scares? Should I hop into G until things stabilize out? Okay. L2050 fund, right? So right now, the composition of the L2050 is 41.22% C fund, 11.92% S fund, 28.61% I fund, 7.83% F fund, and 10.42% G fund. So the L2050 has more exposure to the stock funds. The ratio that you went to, right, 80-20, has more exposure to stocks than the L2050 fund. So your move made you more aggressive in the allocation, right? When you say I just left L2050 and I went to 80-20 CNS, you got more aggressive.
Yeah, you put more into the stock funds,
right?
Because you had 10% in the F fund, and you had whatever it was
10 in the G and 7.83 in the F. So you had 17, 18.
I think a lot of times people think of the L funds as an actual fund, and all it really is a gradually changing portfolio
of the TSP funds,
of the same funds,
the core funds. Yeah,
right. And so if you think of it that way, first of all, they don't stay the same. They gradually change. That's the whole point. And their idea is that it moves more towards G, more towards non-stock as you get older. The market doesn't care how old you are.
Right.
We talk about that all the time. Right. So we're not a big fan of the L funds because of that, because it doesn't take into any consideration what the market's doing. Right. It just says, so if the market was crushing it and you're near retirement, they say you should be out of the market. Right. Even if the market's crushing it. That doesn't compute for us. Right. So,
and vice versa.
Right. Yeah. But so back to the comment. So this person, and I don't remember this. I don't know if I remember it. But so they went from kind of an evenly distributed L2050, reasonably distributed.
Right. Had about 20% in the F and G funds, and went to 100% stock funds. Right. ADC 20S.
Yeah. What we would consider 100% in.
Right.
Yeah.
Right. So you went to a more aggressive allocation, and then. So the next part is, I have 25 years to go, right? Should I care about today's market scares? Absolutely, absolutely, you should care about it, right? It shouldn't scare you. You don't have to act on the fact that the market is doing what it's doing right now, but you should care about the current correction that we're in, and just enough to have a plan, right? The fact that the person put the comment up there means that they care enough to be engaged, right? And so the last part, should I hop into the G fund until things stable out? I mean, the only answer is it depends, right? It depends on how closely you watch the market. Do you want to follow a technical analysis methodology, right? I mean, my answer to this question is much different than someone who uses fundamental analysis or seasonal strategies or something like that.
Yeah.
Right.
And when you say it depends on if you are watching the market, I think we mean by that is, so we would generally agree now's not the time to be into stock funds. We've been talking about that the whole show. Right. So if you take away from that, I should be in the G fund. Yeah, but only if you're willing to get back in when it's time. Right. So you can't just take your eyes off of it and go on vacation after you put it in the G. That's not what we're saying. What we're saying is we are not in the stock market. First of all, we're not telling you to do anything, right? We are not, because of the reasons that Jerry has laid out and that we talk about on the show all the time. We are absolutely not giving you advice, but if you're able to make an educated decision, you can look at what the market's doing and say to yourself, okay, I don't feel comfortable being in now. Then that means you need to have a plan of when to get back in. Right. We call them lines in the sand. Right. Have a line in the sand, and they're really easy to draw out. Go back to that chart for just a second.
We gave you all the answers on that chart.
It's right there. When it crosses that, get out. When it goes back, go get back in. Like, it can be that simple. It truly can. We do all these other indicators because we want higher probabilities.
Yep.
But there are plenty of people that play this game, and I did early on, and I still do in some aspects, honestly, because I don't have time to watch everything. Yep. But I will make some decisions based on major movement only. Mm-hmm. If it crosses a line, I'm out. If it crosses back, I'm in. Yep. And that's all I think about. And that might be 3 moves a year. Yep. Right?
Absolutely.
That might, it might be less. And if you look at really well-run hedge funds and things like that, billionaires and millionaires, that's exactly what they're doing. Right? They're not going to take these catastrophic losses. Right. And they just want kind of slow gains, right?
Yeah, it goes back to Warren Buffett's quote, for sure. Okay, let me see where I was. So we had I don't know, over 50 comments on this post, and the vast majority of comments was 100% be in the stock funds, let it ride. The market always goes up. And the point, obviously, the point of the show is just to give you guys something else to think about other than the market always goes up.
Yeah.
I mean, I don't know how else to put it. So the next one, okay, anybody transfer money out of CNS fund, the market's dropping and it's emotionally damaging. I've been contemplating putting 100% into the L2050, coincidentally, as the last guy, but keeping my contribution the same in 40% L2050, 30S30C. So, yeah, let me...
That makes my brain hurt.
Let's just talk about that last part for a second. The L funds are a combination of the 5 core TSP funds. So the point of the L fund is to set it and forget it, right? It says it all over the TSP chart, the TSP website. The reason they created it is so that when you're first starting out in your career, you're, I don't know, it's like 97% or something in the stock funds. Every quarter, the L fund that you're in, so you pick a fund based on the year that you expect to either retire or need to withdraw the money. So you pick that L fund into the future, and you keep contributing into that fund, and you don't worry about the market. You do your job, you do your life, and at the end, you get what you get. And the reallocation happens every quarter. It does it automatically, decreases your exposure to stocks, increases your exposure to bonds, right? The F fund and the G fund. And in the end, you're
pretty much in the bond. You're
pretty much in the F and G fund.
Yeah.
And then you only to take what you have and roll it into an investment advisor or something, and he says, dude, you can't, you're not gonna outlive your money, so you need to get more aggressive. And you're going, well, wait a minute, I was in this L fund and it did this thing and it was supposed to, I know about the L funds, but now you have X, and if that X doesn't grow, you're gonna outlive it.
Yeah. These are the things that they don't fill in the blanks.
Yeah.
So let's get back to that.
Yeah.
Because that's a crazy combination.
Right. So the point of that whole lead in is that if you are in the L funds, the idea is that you just contribute to the L fund that you chose and let it ride. Okay. You don't want to mess with it by doing some percentage of the L and some percentage of the rest of it. It defeats the purpose of the methodology of the L funds. Like that's so. I mean, if I don't use the L funds at all, and we have a post up on the site about that, why the L funds we disagree with, and why you would combine the L funds with the stock funds. A lot of people do it, and I just don't get it.
Well, I mean, I honestly think it's just because they don't know any better. And if this is your post and you're watching and you think we're beating you up, that is not the case. Yeah. It really is just because we're hoping that it sinks in that is not for A. It's not what the L funds are meant for. I mean, the TSP.gov would tell you that. B, what you did was you took a distribution of 40% of your money across all 5. Mm-hmm. So you are in the GNF.
Yeah, all 5 of them. S, C, and I. Yep.
You're in all of them. And then your other 60% is between C and S. Yeah. And that is a very hard way to manage your contributions.
Yeah.
So either stick to the L funds and forget it.
Yep.
And another thing is to see people, and I could see how you could maybe make sense of this if you said, okay, I want to be more aggressive, so I'm going to be in an L fund that's way far out.
Yep.
And then I'm going to change it to one that's way far in. If you're going to do that anyway, then just get in the regular 5 funds. That's what we say. But I could see people that use the L funds that way. But using the L funds mixed with the other 5 doesn't make a whole lot of sense because you're basically spreading your money across in a way that you really can't manage effectively. You can't.
Not only can you not manage it, you probably don't really realize
what
the
you're
percentage
doing.
that you are overexposed in the stock funds.
Right.
I mean, in this example, if you did 40% L2050, so we said that L2050 is about 80% 80% stocks already. So
20% GNF.
Right, 20% GNF. So then you combine that with 30% S and 30% C. I mean, now you're 95% in the stock funds.
Yeah, you're mostly in the stock funds at a time when you probably shouldn't be.
Yeah.
And it's not not explain it any differently. And again, the idea here isn't that we want to beat up on the folks that make these posts. We bring these posts up because we want to be able to kind of dissect. We have a hard time trying to figure out, right, if there's 17,000 people in this group, like where is the common denominator, right? We know the common denominator in some of the other TSP groups. Yeah. We're friends or acquaintances with most of them, right? We all have different ways to play the game. Yeah. I would argue that the people that started those groups aren't that far away from where we're at.
Sure.
It's just the groups are.
Yeah.
The groups have gone a lot farther to the edges.
Yeah.
The people that started the groups, we don't talk much different than they do. You guys saw, hopefully you saw an interview that we had with a guy who started probably the largest.
Zane.
Scott Zane. We did an interview with Scott Zane. It's up on the YouTube channel. You can check it out. I mean, it's a great discussion between Jerry and Scott, who probably are, if you put our groups side by side, couldn't be farther apart.
Right.
But as people and as kind of market analysts, aren't that far apart.
No, him and I are not far apart at all.
Not far at all. Like, so my point is that what we're trying to kind of get to in our group, is, first of all, we want people to understand what the purpose of the group is. Second of all, if you're not in line with that purpose, then what can we do to kind of better educate everyone so that you're at least having educated discussions? Because when we see posts like this, we automatically think to ourselves, okay, well, this person probably isn't as educated. And I think they're kind of, on a low key kind of way telling us that. Like, they want everybody to know, I don't really know what I'm doing here. What do you think?
I mean, the post is asking for some help. And so ideally, hopefully,
we would hope the answer would be what we're talking about. If someone would come in there and say, "Hey, guy, great, very ambitious way to take control of your account. However, the L fund's really not meant for that. So I'd probably get out of the L fund and then distribute it the way you want, or just go all into the L fund and leave it."
There were some comments about all that, and most of the comments kind of moved back to the first part of the piece, right? Some people addressed the L fund question, but a lot more addressed.
Most people are just saying, "Yeah, just stay in it.
Just stay in it.
Just stay in it."
I mean,
I don't know how you ended up in our group.
The question is, and this is how the chart plays out, which is, it's going to be interesting by the middle of the year, if we're down 40 or 50%. Will the comments be different? I mean, if we're down 40 or 50% on the C fund, is that the time to move to the G fund?
Yeah, I wish that these groups had existed. So I joined Facebook, I think, in 2008. I was reasonably early, and this wasn't even a possibility. Groups didn't exist. All this, there was no way to do all this. But if you had been in a TSP group with 20,000 other people in 2008, the discussions would be very different.
Yeah, for sure.
And the thing is we are a fickle species, right? We tend to forget. We have short memories.
Yep.
And so we think it's like the person's comment that I've been in the government since 93 or 96, and it's never gone down that much. You have short-term memory loss or long-term memory loss.
Yeah.
It has. So a point is, we haven't gone through one of those except 2020. We had a short one. And so if that's your come from, you think, oh, it just rebounds quickly. Yep. And it did, and it's great that it did, right? We were out, got back in, but it normally doesn't happen that quickly.
Yep.
And so that was a one-off. That wasn't the norm. And if that's the case, we have to be watching out for those 2001s, 2008s. We have to be watching out for those. And none of us were on Facebook then.
Right.
We weren't on social media. Maybe you were on MySpace. I don't know.
Right. I mean, at the end of the day, let me just go back to this chart, right? And this is why I'm calling it the only chart that matters. at the end of the day, if you can set aside what you believe, right? If you believe the market always goes up, great. If you don't want to deal with the day-to-day, week-to-week kind of look at the market, fine. If you just keep this chart somewhere in your head or on your desk or whatever, when the market gets above that downtrend line and above that moving average line, then there's a possibility, that there's much less risk in it rolling over, right? And since there's less risk in it rolling over, it makes sense to get back in. Let's say you're looking at this and you got back in like right there at, what is that? 4,400. Okay, let's say you get back in there at 4,400 because it's the first round number after that downtrend line. If the market keeps going up, that's awesome. If it comes down and gets below these lows, you're going to take that little loss. But the odds of it, if it does get below that low, the odds of it coming down are significant.
The probability is very high.
Yeah. So, it's managing downside risk. That's all we're doing.
I'm going to tell you an easier way than printing that and putting it up on your desk.
What's that?
Just watch our show and join our site.
Yeah, 100%.
Join our site. We're going to tell you. Yeah. We're going to send you a nice little alert that says "Get out."
Yep.
Or not, we're not going to tell you to get out. We're going to tell you we got out.
We got out. Yeah.
Or we're back in.
I mean, we had a lot of people in January that were
questions. I hope we get a lot of good questions out of this. I really do. We kind of like sometimes doing these shows where we're not spending the whole time on charts. And I know it looks like we may have in this one if you're just kind of getting new to the show, but we normally spend a little bit more time. And so this show, if anything, if you take away, this show was probably more educational than a lot of the ones we do. A lot of the shows that we do are probably more educational on how to learn technical analysis, right? Jerry kind of gets in the weeds to try to show you how we apply this, and we do charts of things that are not on the TSP, right? We'll do like Peloton
bonus chart.
or the bonus chart, and we do that because we want to show that these things apply outside of the TSP. It's not just the TSP, and so you can apply these methodologies to any sort of investment.
Yep, 100%.
And it works. So if you have questions, give them to us. We'll take them. It does take us a little while to get to them all sometimes. If you tend to do it on YouTube, like we're not on YouTube a lot, but we eventually get a notification. We'll try to go in. Like I answered a couple today. If you hit us on Facebook, we're usually pretty quick to do that if you see it on Facebook. If you see it on the site, we usually get a notification. Yep. So anyway, wherever you find this, on social media, our website, YouTube, whatever, if you find it in outer space, let us know.
Share it with your friends. I mean,
please.
If it makes you think outside your box, then we were successful.
Absolutely. And particularly this episode, hopefully if you're watching it on Sunday or Monday, sit it around the office and let everybody get in on the discussion, because this is a time when a lot of people are scared and they're not willing to admit it. Most of us govies and military folks, we kind of pound our chest and we're egos and all that kind of stuff. And we're like, we're not willing to admit that we don't know what's going on. Yeah. Right. And so this is a discussion that we need to have more of. And that's why Jerry and I started this whole project that's turned into a business, is because people aren't having these meaningful discussions. They sit around the water cooler. We don't do that anymore, but, we sit around the Slack chat or whatever it is, and we talk about, all of this. And we just want you guys to have educated discussions. So do your best with that, and we are going to go enjoy a few days off, and we'll be right back at it.
All right.
See you guys.
See you.
Boom.